Hello and welcome to Portfolio Matters. In today's My Worst Trade, I will be confessing to my disastrous dalliance with the iPath S&P 500 VIX short-term futures ETN, which I bought as a hedge and it weren't. Before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Let's hear about your foray into the iPath S&P 500 VIX short-term futures ETN, Keith.
But first of all, an aside. The Kruger-Dunning process. Or, this is why A, internet chat rooms are dangerous, and B, it explains why a little knowledge is a dangerous thing. So this comes from an observation, actually, that Dunning made, that the thickest pupils in his class seem to be the ones who are the most confident. And so he drew this chart. Basically, everyone assumes initially that they know all about a subject and their confidence is high. And then as they become more knowledgeable about their subject, they realize how complicated it is and their confidence declines. And so you get this dip. So initially you're very confident. Then as you understand the complexity, you become less and less confident. But then as your experience grows, you become more confident again, but fully understanding the complexity. And as an aside, one of the subjects that Dunning and Kruger studied was Arthur Wheeler, who in 1995 robbed two banks while covering his face with lemon juice, in the mistaken belief that covering his face with lemon juice made him invisible. And he seems to have come to this belief through somehow mistaking lemon juice's properties in invisible ink with the fact that if he covered himself with it, he himself would become invisible. Anyway, so in this trade, I am MacArthur Wheeler walking into the bank, my face covered in lemon juice, because I bought the iPath S&P 500 VIX short-term futures ETN on the basis of my limited knowledge about VIX. And so I thought that VIX would be a good insurance policy because VIX tends to spike whenever there is a problem in the market. So volatility spikes, VIX spikes, you make money, was my thinking. So if the market falls, VIX will spike. I will offset some of my losses in the stock market by making money on VIX. That was kind of what I was thinking. And the lessons from this My Worst Trade are going to be, don't trade something you don't fully understand, basically. If you trade something you don't fully understand, there is a price of education, and that price of education can be higher than you would like. And VIX essentially is not a good form of insurance. It works, but you don't want to hold it for literally more than a couple of days. And we will go into why. And what this whole trade taught me was the importance of understanding contango and backwardation in the futures curve if you are trading futures. And actually, the iPath S&P 500 VIX short-term futures ETN essentially trades futures. And I didn't understand that, and it cost me money. So this is the all share. And to understand my why I wanted to buy insurance, in 2009, obviously there'd been the great financial crisis, and then the markets have bounced back very strongly. And I worried that the market had come too high too fast, and I wanted to essentially remain exposed to the market, but having some insurance in case the market turned down again. Now, what is VIX? Well, VIX is short for the Chicago Board of Exchange Volatility Index, and it is measured from implied volatility in options. And so the more expensive options are, the more the market is expecting volatility and the higher VIX is. And this is the volatility index. And you can see that during the financial crisis, VIX would have been a great hedge. VIX spiked from 16 up to 80, so it went up fivefold. So my idea was I could potentially offset any losses in my portfolio by holding VIX. And if the market crashed, I'd make some money back because buying VIX would be profitable. Unfortunately, that is not how it worked. And the iPath S&P 500 short-term VIX ETN is still going. And we'll show a chart of its long-term performance in a minute, but this is the chart over the period I held it. Essentially, it lost money every day, and I couldn't understand it. For the first few days, I thought, well, I didn't really understand what was going on. It's only after it had gone down pretty much every day, and I'd lost, a decent chunk of my actually fairly small investment, that I started to work out what was going on. And this is the long-term chart. And frankly, if you were to reduce the scale, you will see that over every period, this is the chart. It declines consistently over time. But it does work in short term. If there's a short-term spike in volatility, you can make money, but it's not something you want to hold for any period of time. Now, what's going on? Well, what's going on is you have to understand the futures curve. So what the iPath VIX ETN does is it aims for always being 1 month ahead. So you're looking at having exposure to the VIX futures curve 1 month ahead. So every day it is buying the VIX 2 months ahead, or a month and a bit ahead, and selling near-term VIX. And so the shape of the, as long as the futures curve is shaped like this, it is buying expensive volatility and it's selling cheap volatility. So what the chart is saying is that in the short term, we don't expect much volatility, but in medium term, we fear that VIX could spike. And so every day you're buying expensive future volatility and you're selling cheap near-term volatility, and that costs you money. And so the technical term for this shape of graph is contango. And so as long as you have contango, then you lose money. So this is a futures chart with contango. The opposite is backwardation. And backwardation is when near-term volatility is more expensive than future volatility. And this generally happens when there has been a short-term crisis. So you'll see in the aftermath of the financial crisis, you'd have backwardation as short-term volatility. And there's a lot of fear right now, but people think that going forward, the market will be all right. Now, another example of when you really need to understand the exact details of a futures contract was provided last year by the WTI futures contract. That's crude oil in the US. And you'll see that in April last year, the price of the WTI futures contract settled at almost minus $40 a barrel. And anyone who had that contract lost a lot of money. Now, and what was going on then is that the international oil futures market in Brent, which is in London, settles in cash. So when the futures settle at the settlement date, everyone knows what the price is and their cash changes hands. In the US, there's physical settlement. So when the futures closes, if you're long, you own a barrel of oil. And there are a lot of people who had bought oil who didn't understand this. And then as you got close to settlement, they were being asked, well, you've got 100,000 barrels of oil. What do you want to do with it? But all the storage was full. And so there was this panic to try and offload their liability, essentially. They were going to have to accept 100,000 barrels of oil, and they now needed somebody to take that liability off them. And ultimately, that liability was $30 a barrel, $35 a barrel. So, you really need to understand the details of a futures contract if you start playing around with them. So, in summary, VIX is not a very good hedge if you hold it for the medium term. You need to understand the term structure of the futures before you start dallying in futures, frankly, and you need to understand the difference between contango and backwardation. And yeah, don't mess around in things you don't understand. So frankly, I've never traded it again. Richard, your thoughts?
Thank you, Keith. It's interesting. I mean, I think most people, and myself included, up until recently, didn't even understand what volatility was, in the sense of how could you possibly buy volatility. And then, as you say, the explanation of it being calculated from the option pricing and the amount you need to pay for the probability of the share price changing as a result of between the time you buy the option and the time of the option expiry, and the premium that the option issuer wishes to take to cover their risk is how the volatility index is calculated effectively. So it's very esoteric, isn't it? And then when you move into the issues of contango, backwardation, and commodity futures tradings and commodities, you get into areas where I think it's incredibly easy to not understand fully what's going on and make a mistake. And I actually made the same mistake with the 3 times leveraged GDXJ. What's it called anyway? I can't remember. And this is some time ago. I thought, wow, I can buy gold junior miners with 3 times leverage. I'll have some of that. And basically, unless these shares are going up, the share prices of the underlying companies are going up, you lose a chunk of money every day. Yeah. Because they roll it every day. And any financial instrument that rolls every day has a huge cost to it. And it's so easy not to understand that. And I think this is really important. It doesn't just apply to VIX. Obviously, it's important with VIX. It applies to all sorts of futures contract ETFs or ETNs, which people don't really understand. Yeah, I think it's really important. The other thing is, it's very important to understand where you have this risk. And I think, I didn't understand that. Personally, I didn't understand I had that risk with the 3 times levered ETF. And obviously, you didn't understand you had that risk with the VIX contract, and you can know all about it, but still make the mistake if you don't realise this is how a particular security works. Interesting.
Yeah, no, I basically didn't do enough research. Essentially, didn't understand it fully, and it's taught me a lesson. But it's one of those things where you have to you start off overconfident, and then you learn how much you don't know.
I think it applies to a lot of these instruments. I was looking at something. This might be a bit of an aside, but I was looking at a graph of ARK. The ARK ETF in America, which is the famous technology ETF that's come to life quickly recently, and they have a mixture of liquid and illiquid holdings. And what this chart was saying was basically, if everybody bails out of the ETF, they sell the liquid holdings, and what's left is the illiquid ones. And so you don't own what you think you own in these things if the circumstances change. And I think there are an awful lot of pitfalls waiting out there for people because of the complexity of the financial instruments and the different ways in which they can behave in different environments.
When you talk about that, Richard, that is the Woodford effect, isn't it? Essentially, if you hold illiquid stuff, when you get redemptions, you have to sell the liquid stuff. And so whoever is left has a terrible portfolio full of illiquid stuff that you can't sell. I hope you all enjoyed that. And if you can press like and subscribe to our channel. And in the meantime, it is goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.